Here we go. Wholesale Hotline. This is going to be an incredible show today. It is, this is what, number 49, right, Pace? Number 49.
Yes, sir.
We're going at this 49 times for 90 minutes. It is a 90-minute show where we answer your questions about wholesaling real estate, about investing in real estate, about being a real estate entrepreneur. We bring on the absolute best guests from around the country so that you can fire questions at them and get the answers right now so that you can implement them. We do the show on Monday so that you can put them in action, all the questions, all the answers, all the instruction, so that you can put it in action for the rest of the week. So it's going to be phenomenal. Hopefully Jamil pops on here soon, but Pace, why don't you introduce our guest today?
Michael Zuber is a friend of mine out of Fresno, Arizona. He has, I don't even know how many doors this guy, Fresno, California. I apologize. Fresno, California. He is an amazing investor, primarily focusing on cash flow right now. And I would say Section 8 out of California are primarily where all your doors are, right? Is that Michael, right?
Yeah, California is 100% of my rental portfolio, correct.
Love it. And you do a lot of Section 8. You and I have done podcasts together. I think we've done 3 podcasts together. You are so highly respected in the industry, especially around your peers in Fresno. You are like the guy. You have an office in Fresno where you are, I think honestly, it's kind of the future of the game is having these offices where you have multiple people and multiple businesses in the same building, which would be wholesale, Airbnb, construction, and maybe some other stuff too, buy and hold businesses, et cetera, inside that same business. Mm-hmm. What are your plans for 2021, bro? Tell me all about it.
Well, really, my plans for 2021 kind of are to go bigger and better on what we were doing before, which really, for me, boils down to a couple of things. First and foremost, my goal for the next 50 years of my life, and I'm just about that number, is to create something that impacts, thousands, if not hundreds of thousands of people. I'm going to measure the success of my future or my legacy to see if I'm still as respected and impactful 50 years after I'm dead. Right? I'm already sitting in a situation where my bills are paid. I have enough. So now it's about giving back. So that is the number one focus for 2021, whether that be working with entrepreneurs in Fresno inside the hub, which would also include licensed real estate agents, whether that's working with other California investors on buying properties, whether that's just on educating people around finances via a daily financial show, or having people think about opportunity cost of time versus just the price of things. There are so many ways we can help people going forward. That's really my lion's share. Yes, I'll add more rentals. Yes, I'll do some flips. Yes, I will sell more books and courses, but it is about everyone else for me in 2021.
Love that. That's amazing. So, you and I had a really good conversation about Section 8 last time. So many people had questions about it. I think what we should do for the time being is I think we should really put in the minds of the Wholesale Hotline community what a buyer is looking for, right? And so we talked about yield. So I look at wholesalers, right? People trying to get into the business. In fact, I did this the other day. I was in Orlando with Jamil, and we were talking to this big group of people in a soccer field in the open, air, obviously because of COVID. And these guys were asking me a question about this deal. Hey, do you think it's a good deal? Hey, do you think it's a good deal? And I said, well, I don't know. Why don't you put yourself in the shoes of the investor and figure out if you would buy the deal from yourself? What's up, Jamil? Good to see you, brother.
Hey, guys. Can you hear me all right?
Yeah, we can hear you great.
Awesome.
So you got to put yourself in this position of the investor and figure out what is a good deal. And so many times we talk about comping based on the cash buyer who's going to ultimately fix and flip. Let's talk about what would a cash buyer who's going to buy and hold look at? Is it yield? Is it a cap rate? What are the terms that a brand new wholesaler should be focusing on understanding to sell or wholesale or sign a contract to a buy and hold investor such as yourself?
So that's a great question. We'll kind of break it down. So you asked what I would look for. We'll answer that. We'll even break it down further for someone that might, because I look at, I help people around the country. So what I look for is yield. And it's a very simple math equation, but it is math. So let's walk this through, right? There's two numbers. It's a numerator and a denominator. The denominator is easiest for most people to understand. So let's talk about that first. What I need to understand is how much cash is this going to take from me? And I mean cash. How much cash has to come out of my checking account, right? Or my money market, or my savings, or my stock, whatever it is, right? How much cash comes out? From a buy and hold investor, that's typically three factors, right? Is it a full cash purchase, or is it a down payment? What kind of closing costs am I responsible for? And then most importantly, which a lot of wholesalers probably wouldn't consider just naturally, is what is going to be the make ready to make that asset produce income, right? Because I'm buy and hold, right? And I want an asset that's producing cash flow. So you have to add all of those up. Some of you may be thinking about it already when you're talking to your fix and flip folks. But realize a fix and flip person who is flipping to an end buyer or owner is very different than flipping for a rental, right? The quality and the upgrades and the touches are a little bit less, right? You don't do the same kind of upgrades. So that make ready may be less. So that is the denominator. Now the numerator is, what is my expected cash flow for the year? So some people get all wrapped around the axle and go, what is that? Well, you take the expected rent and then you minus all expenses, mortgage payment, taxes, insurance, reserves for bad debt, reserves for maintenance. And at the end of that, that is going to likely, or it will produce a positive number for net cash flow of a month. You take that by 12. So you just take the numerator divided by the denominator. If you want to turn it into a percentage, you multiply by 100. And that produces a yield. It's basically turning an investment into a bond. That's all it is. It is a bond, right? What does a bond produce? Well, in Fresno, California right now, a good deal produces a 6% return.
Interesting. 6%. So here's my yield. I was just talking to somebody about this the other day. So my yield, like Michael just explained, I'm going to make it in my own words, is if I put in $30,000 into an investment. So let's say I take over somebody's subject to home, right? Let's say as a cash buyer, Brent Daniels, for example, is wholesaling a deal to me right now. It's a subject to deal. Okay. So keeping true to Wholesale Hotline, how does Brent Daniels wholesale a deal to a guy like me? And how do I make a determination that that deal is a good return on my investment? How do I make that? How do I go, dude, that's a deal I want. Brent, assign that deal to me. That's what we're trying to do here on Wholesale Hotline, is figure out how to wholesale these deals. So I looked at the deal and I said, okay, if I'm going to have to pay the cost of the seller, there's cash to the seller, there's cash to Brent for his assignment fee, closing costs, renovation, vacancy while I'm cleaning it up and getting it rented out. And then ultimately my cost for utilities and miscellaneous things. What is my total entry fee is what I call it. What's my entry fee to that deal?
That's the denominator. Perfect.
My entry fee is $30,000. Okay. So that's everything. I don't have to get a loan, which is great about sub 2. Michael, you and I have talked about this as well on Sunday service. I don't have to go get a loan. So that's cool. Right. So if you're going to wholesale a deal to an investor like myself, and you're wholesaling a subject to, you have to let them know, dude, you don't have to go do the BRRRR strategy. You don't have to go get a hard money loan and then ultimately refinance it. Wholesaling a subject to deal to me makes my life incredibly easy. So the only cash I really need to come up with is the money to the seller, the renovation, et cetera. So if my cost is 30 grand and I want a yield of 10%, that means that I need to have a net return of $3,000 at the end of the year. So what does $3,000 mean? That means after I pay my private lender, after I have all my expenses, my payments, my taxes, my insurance, even my fluff account for repairs and vacancy, all of that's taken into consideration. And if I net $280 roughly a month on that deal, and
it's exactly $250.
Okay, so exactly $250. I net $3,000, and that is a 10% yield on my investment of $30,000.
Every time.
Okay, that's a great return, because not only am I getting my 10% yield, I'm also getting my mortgage paid down by my tenant. I'm also getting tax depreciation. I'm also getting crazy appreciation, especially during these up times right now. And so that is the mind frame of a cash buyer. And once you understand the mind frame of a cash buyer, you can really, really start comping properties. Jamil, you just jumped in here, so we missed you at the beginning. At Keegley, how are you guys making a determination for your cash buyers who are ultimately going to buy and hold these properties?
Great question. So obviously it really depends on market, right? So if we're talking about the Phoenix market, that's going to be a completely different story than Florida, Tampa, Orlando. It's going to be completely different if we're talking buy and hold in California. As Mike just described, the yield or the cap rates that are a good deal in California is a 6 cap. If I try to bring a 6 cap to an investor in Arizona, they're going to laugh me out of the conversation. They want nothing to do with it, right? And so the market is going to dictate what a good yield is. So over here in Arizona, specifically in Phoenix, as a wholesaler, I'm trying to contract. So I'm going to be contracting based on what my rents could possibly be. So here's the fun thing. If you're a wholesaler and you're out there and you want to get involved in multifamily or you want to go pick up single family rentals, you want to find opportunities where the rents are low and that where the rents could be raised. So let's just say, for instance, right now, your average rent for a small 2-bedroom apartment in Phoenix is over $1,000, $1,100, even $1,200. So if I can pick something up where, say, that same unit is being rented right now at $7,000, I know that I have the capacity to raise my rents, by $500 a month. That $500 rental increase is going to create the gap that I'm looking for in spread. So I'm going to be evaluating the deal based off what the potential rent can be, but I'm going to be buying it based off of what the current rent is. And that's just like what we do in wholesale. We buy a property based on its current condition, and we sell it based off what it could be once it's fixed. Same thing works for rentals. You buy it based on what it's being rented at right now, and you're going to sell it at what the rent could be. So what they're looking for in Arizona is a minimum of an 8 cap. An 8 cap is a good rental in Arizona, but investors will jump at a 10 all day long. So we're always trying to contract at around a 12 and then sell at a 10.
So Jamil, are you putting that information out when you blast out these deals? Or are you just putting an address, price, pictures?
If we think that the play is going to be a rental play, absolutely. Absolutely, we're putting that out. We're explaining what the value add opportunity is. A lot of times, though, that conversation is going to happen over the phone. You can't get a lot of that detail out in an email blast. Like, here's the play, guys. You're going to buy this. You're going to kick everybody out. You're going to do some improvements, and you're going to raise the rents to this. Your cap rate's going to be that. A buyer attention span is very short, and so we're going to say value add opportunity, severely under rented, and that's going to signal to the buy and hold investor that there's a play. When I write severely under rented and priced accordingly in my ad, that tells Mike Zuber that he needs to pay attention to my ad because this property is severely under rented, and it's priced accordingly, and he knows that now all he has to do is raise the rents and he's going to gain equity.
That's incredible, because I think that's really important that if you're going after specific deals and you're following up and you know that it's a good, motivated and a distressed property owner, they want to get rid of the property, but maybe the pricing just doesn't work out. What you guys are saying is you can use this equation to see if it makes sense to a buy and hold buyer as opposed to somebody that's fix and flip, because we primarily talk on this show about selling deals to fix and flippers, right? You know what I mean? That's essentially what we do. Go find the ugliest houses that you can, with that you can get them as low as you can, sell them for as much as you can. And typically that's going to be somebody that has construction background that can take that property, fix it up, make it look beautiful, and for the most part, put it back on the market. But what you guys are saying is we're going to equip the audience tonight with another tool that says, listen, if you use this equation that Michael's going to break down and explain everything, he's going to explain what a cap rate is. He's going to explain the yield. He's going to go through all these things. These are like big words. You're using big words, Mike. I'm like already lost, but I'm writing it down. I'm taking notes. I'm serious. I'm very like basic with this stuff. But what you're saying is if you can understand what investors are looking for from a yield percentage, then you can go after deals that you thought were a little bit too tight and actually make something on them.
Yeah, I think there's a couple of things that I would, I would coach all of you or suggest all of you and all of your followers to think about, especially in the times that we are in now and where we likely will evolve as we get through eviction moratorium and forbearances and all of this. Right now you may be going after the ugliest houses and you're looking for flippers, right? That's where the meat on the bone is. That's where the opportunity is. Go for it. I mean, have fun. I see it all the time in Fresno. Keep upgrading houses. It's good for everybody. Thank you very much. But what's going to happen in 2, 3, 4 years when we go through another economic cycle and we have another recession? What's going to happen is what will very likely happen in the very near future is interest rates will be up. They may not be up a lot, but maybe they'll be 4.5%, 5% on a 30-year fixed. But why I'm bringing this up for the subject 2 group is you're going to run into people that have very skinny equity. Maybe they have 5% because they put 3.5% down or whatever it is. But the magic, the sprinkle of love that they're all going to have is they're going to have 30-year debt fixed at like 2.3, 2.4. That is going to be meat on the bone to a buy and hold investor, right? Subject 2 is going to be probably the number 1 vehicle I add units to in the decade to come, right? Because we're going to go through a time, just again, I've been doing this 20 years. Interest rates likely have bottomed. They are likely going to be rising. We've printed 20% of all dollars ever created in the last 12 months, and we're going to do it again. So that is going to eventually take the 10-year treasury up. It's going to make the 30-year mortgage up. We're going to have another recession in the future. No doubt. When it is, who cares? It's going to happen. And then you guys are going to be able to go into subject 2. And why that's important is you're going to go into subject 2 into very new homes, 5 years or less, 8 years or less. These aren't going to be the ugly homes. These are going to be the track homes. These are going to be the person that bought in California or Arizona or wherever. And you know what? They got to move for a job, right? They got to go somewhere else. And they're like, I don't have any equity. I can't pay a real estate agent 6% and closing costs. I got no room. You come in with subject 2. You got a 30-year note with 24 years left. The note's 2.3. I'm going, I can make that work because, oh, by the way, rents are up and supply is down and lots of goodness to come. I forgot where I was going, but I'll stop there.
Let me jump on that real quick.
Say people make money in downturns?
Yes. Mucho dinero. You make a lot of money in downturns. It's crazy. So I want to jump on something just real quick and talk about what's the goal as a wholesaler, right? The goal as a wholesaler is to, number 1, get into real estate as inexpensively and easily as possible. It's the easiest way to get into real estate. And then on top of it, it's the gateway drug to everything else. If you can wholesale, you can go anywhere in this country. In fact, you can go anywhere in this country and make a really good living. Okay. But once you go past that, once you go past that point, let me see if I can get this to pop up. Might be a little challenging. I want to do a little presentation on my little iPad, but once you start making money in this business, guess what you start doing is you start paying pretty insane amounts of taxes. Okay. I had a good buddy of mine, wholesaler last year, said, "Hey, Pace, I made $400,000 in wholesale commissions last year after all my expenses." And I said, "Oh, is that after taxes too? Dude, that's pretty dang good." He goes, "Oh no, I haven't paid my taxes yet." Okay, so you didn't make 400 grand. You made 400 grand, and you made 400 grand into a bucket, and you have to cut the top of that bucket off and give it to Uncle Sam, which is probably, what would you guys say is 400,000? It's different in California, but a national average, if I make $400,000, I'm probably going to give a good 160 to 180 of that back to the government. So I really just made $220,000. Okay. Yeah. So Brent Daniels on his YouTube channel has done multiple videos about this exact topic. Once you start crushing it in wholesale, you really need to start building your cash flow. Okay. And when you look at Michael Zuber's book, it's one rental at a time. Okay. Why do we care about cash flow? Well, I care more about the tax benefits of rental properties than I even do. I care about the cash flow. Cash flow is cool. It's the best. I love it. But at the end of the day, I don't want to earn $400,000 in my wholesale business and give $180,000 of that back to the government. So, Michael, have you used depreciation in your business to offset your other expenses and tax liability?
Every year, brother.
It is the magic sprinkle dust in this business, guys, is that once you start making, I know how much Brent Daniels makes. I know how much Jamil makes. I know how much the tax man wants of these guys' money and my money and Michael's money. And so when you start crushing, I see these guys saying, hey, I made $13,000 on this assignment fee. I made $50,000 on this assignment fee. I made $80,000 on this fix and flip. Guys, take 30 or 40% of that right off the top, and that's going to the government unless you do one thing. There's only one thing that I know, only one thing. It's not whole life insurance policy, because guess what, Adrian Jeffrey? That's a really great comment.
It was great. It was pretty timely, Pace.
It was timely. We just sat and learned all about this for a long time. Adrian Jeffrey, people put money in their whole life insurance policy after tax dollars. It is not a tax vehicle. It does not save you money in taxes. Okay. So no, there is only one proven way that I know of, and I would love to hear somebody else's thoughts on this, that can literally offset your entire tax liability on a yearly basis. And my experience says rentals. Cash flowing rentals, cash flowing assets is the only way to offset all of your tax liability. Now, in order to never have to pay, that was an interesting conversation. Now, I don't want to get too deep in the weeds. I think we stop on a couple of these topics and deep dive on some of them, like what's cap rate and what's some of this stuff. But once you start using your rentals to offset your other income, now you're living mostly, or if not like I did in 2020, a tax-free year. Now I use my whole life insurance policies and other things like public charities to offset my cash flow from tax liabilities, which is super interesting topic as well. We won't go down that road today. Ryan Peterson says depreciation recapture. Jamil and I just learned one of the most amazing ways to avoid depreciation recapture in this last week's mastermind. Like years and years of doing this, I just had my brain was spilling out of my ears. It blew up in my head. It was so fun to learn.
Look at what Mohammed's comment was right underneath it.
Yeah, donations, love it. I would rather make donations to my own family than I would to somebody else, to be honest. So talking about public charities, you can donate your stuff to your own private foundation, which is super cool. So private charities, which is stuff you control. Now, there's a couple people in here that asked questions, and they said, what is a cap rate? Cap rate is an interesting topic. I hear it all the time. Michael, in your own words, is there a difference? And if there is a difference, what is it between yield and cap rate? Are they the same thing, or are they slightly different?
They're slightly different. Cap rate is used by multifamily investors, commercial properties. It is how all commercial properties are compared. The issue I have with cap rate is it assumes you pay for the property and make it free and clear. That's the problem. Most of us, myself included, I don't pay cash for properties. That's not what I'm looking for, right? I really just want to know how much cash comes out. It's usually a part of the down payment, part of the closing costs, and make ready. That's what I want. So yield and cap rate, try to get at the same thing. But here's the deal. People throw around cap rate either as A, because they don't understand it, or B, because they're a commercial broker and they're trying to confuse you or make themselves look smarter than you. That's how I feel about cap rate.
Mike, can I ask you or add to that a little bit? The one thing that I've always found cap rate doesn't address is appreciation, right? And when Michael talks about yield, I would look at yield as an all-encompassing return on my investment, right? What's my yield on this property? So I got 10% cash on cash return, and then I appreciated 8% over the year. What was my total yield, right? That's what I'm looking at and when I'm looking at yield or return. And cap rate, unfortunately, doesn't even take into consideration appreciation. And so I think it's kind of a rudimentary or like a real low line way to. But you're right, Michael. They all use, commercial brokers will use that as the the dancing post or the dancing pole to swing around.
Yeah. So just so we're clear, right? Appreciation shouldn't be in your any calculation at point of purchase,
Right.
but should absolutely be evaluated when you're looking at your personal portfolio and looking at how you did for the year and all of those things. Absolutely. Filling out a financial statement, all of that stuff. I don't suggest anyone looks at appreciation or potential for appreciation in a deal up front. But let's be clear, that doesn't mean a discount, right? You talked earlier, Jamil, about buying a deal, right? I'm 30 points undervalued or something. Those are different things. I just want to remove appreciation because I've been doing this 20 years and I saw millionaires go broke in California because they were betting on appreciation in 06, 07. They made millions of dollars in 05. They all lost it all in 07. So I'm a little hypersensitive to that word because I've seen what it could do and it could destroy people. So a little caveat.
And I think
So
to your point real quick,
Yeah.
we're all partners. We're all partners with the federal and the state government. All right. They get a piece of it. Right. But the interesting thing is when you talk to this partner and you say, hey, is there a way that I can pay you less and impact the community more? They go, well, you could buy housing. We don't like dealing with housing. We're pretty bad at housing. Actually, we're not that great. If you take care of it and keep it fixed and livable and good, and we'll help you out on your taxes. That's essentially what it is, right?
That's exactly what it is. They're incentivizing you to help create affordable housing, which is going to be one of the world's biggest problems going forward in the next 20 to 50 years.
Housing crisis, housing crisis, housing crisis, housing crisis.
We're seeing it right now. I mean, you drive
Jamil?
anywhere in the country. Jamil and I are traveling all over the place. The number one thing that's getting built right now, you think it's mansions? No, it's apartments. They can't keep up. There's too many people.
Brent, housing and 100% pace, and I think we're heading for a housing crisis because, in all honesty, we've got so much private equity in the marketplace right now that owns so much of America, so much of America that what we see in terms of like normal market bust and boom cycles is going to be offset by the amount of institutional funds that are in the marketplace. They're not going to allow the cyclical nature of the market to determine their profit margins. When you're talking about billionaire hedge funds, they're going to hold their property, they're going to hold their asset as long as they need to recover any kind of market downturn that could potentially exist. And because of that, I believe, just like you see when large companies come in and buy up a stock of a company, they're doing that on purpose. I think that private equity has come into the marketplace on purpose, and they're continuing to take on large amounts of the United States housing inventory in that lower income bracket, or in that affordable housing bracket, because there is going to be a diminished number of units available for rent. And that just means that rents are going to spike. And because we don't have wages raising at the same rates as rent rates are increasing, we're going to have a housing crisis. I've been calling it for a year. That's where I think we're headed.
So you're saying there's not going to be enough housing for the amount of people.
I think there's not going to be
housing crisis.
Housing. I think that we're going to, right now, we used to see you could rent a 2-bedroom apartment for $700. Doesn't happen anymore.
Nope.
It's like $1,000, $1,100, $1,200 now. I think you're going to see that same thing, but it's going to be like $1,500.
Got it.
So check this out. I figured out how to make this happen here. I'm going to go solo on this real quick. So let's look at a wholesaler, and let's say Brent. Let's change this guy's name. This person makes $400,000. Let's just say his name's TTP. Okay, $400,000 is an easy number.
You're short a couple mil there, bro.
No, I know that, but you know what? You're right. Let's screwing this up. I'm sorry. Let's say this guy's name is Paul.
Okay.
So Paul's a wholesaler. He makes $400,000 in checks. Okay. That means he's paid for his advertising. He's paid for all his stuff. And he gets $400,000 in checks. He deposits those checks into his bank. And at the end of the year as a wholesaler, and if I made $400,000, how much is my tax liability? Okay, it depends on who you are, depends on if you're married, depends on a lot of things. But let's just kind of take an average. I would say that the government's going to take about $160,000 of that money right out of the gate. Okay, so that means you really only made $240,000 in this year, not $400,000. This money goes to your government partner, as TTP talked about, your government partner. Okay. That would be your state. That would be your IRS, et cetera. Okay. So $160,000. Now, I, as a business owner, I look at this $160,000 and I'm like, man, there's no way you guys can manage that $160,000 as well as I can. So like Brent said, you said the government partner says, you know what, if you don't want to give that money to us, we will incentivize you if you go buy properties with this. And I would say that my average sub 2 deal is about, let's say $20,000 is what it takes. Okay. National average is probably closer to, let's say $12,000. You got lower end markets that are like, I bought a deal in Vegas in January of last year that cost me closing costs and I took it over. Okay. And it's an Airbnb. I net $1,900 a month on it. So that means if every deal is $12,000 on average each in terms of what is it? It's going to be closing costs, cash to the seller. It's going to be a little bit of repairs and then get it rent ready. Let's say it's average of $12,000. How many deals can I buy with $160,000? Let's look at that. Let's see. Let's just say it's 14. That's 15 deals. I could buy 15 rentals at that rate with that same amount of money. Okay. So while everybody's giving their money to the government, they're missing out on the fact that, man, you're in the best business of all time, which is wholesale. Wholesale allows you to make that $400,000, but unfortunately, wholesale doesn't allow you to keep it. But what wholesale does is it gives you the opportunity to be, either buying subject to deals or, buying some of your own properties with cash or whatever it is. You do the Burr method on this, whatever. Out of those 15 deals, Jamil, what would you say is the national average? What would you say is the national average price of a home that you guys are dispoing right now? Is it 150? Is it 200? What would you say is that price?
Like national average?
Yeah, national.
It's probably around a little over 200,000.
Okay. So if I'm buying, let's be really, really simple with this. If I buy out of this $160,000, let's go through this again. Let's be very conservative. Let's say instead of it costing 12, it cost me 20,000. So you can buy each one of these. That means I can buy 8 properties at $200,000 value each. That means I have now in property real estate. I just bought $1.6 million in real estate. What's cool about that, now Michael knows this, he's crushing it on this. But what Michael knows is that his tenants are paying down the debts on that. His tenants are allowing for the houses to appreciate over a long period of time. Obviously, it ebbs and flows and all that kind of stuff. But here's the thing that we're missing out on. Okay. Now, we've got $1.6 million in real estate. Now, I can go to my government partner and say, hey, remember IRS, you said if I use this $160,000, instead of giving it to you, I can go buy real estate with it. The IRS allows you to do something called depreciate your assets. Okay. They think that after 27 and a half years, those properties are basically worth zero. So you can divide that out. And I'm not going to get into the weeds on this because it's actually very simple. This is the way I look at it. In the first year, in the first year of me buying these properties, I take about, do you do advanced or bonus depreciation or forced depreciation in the first year, Michael?
Only on larger apartments. It doesn't work on houses.
Okay. You're talking about cost segregation.
Right.
Okay, so on my CPA allows me on single family homes, we take the first 5 years of depreciation up front.
Cool.
So let's say that I do that on these properties. Essentially, here's what happens. I just bought those $1.6 million in property. I get about 25% of those houses worth of value in a tax credit. What is that? It's $400,000. So I get that tax credit, that $400,000. Look,
sorry, Pace, you're not showing your screen. You probably want to be showing your screen.
I hate when I do that.
Nope.
So I get that $400,000 tax credit for buying those properties, and that $400,000 makes its way all the way up here, all the way up here, all the way up here. And it says, hey, you know that 400 grand that you said you made, you actually, because you took an IRS credit, we're going to say that you made zero, and we're not going to ask you to pay that. So instead of you taking home that $240,000, you then technically were able to take home and not take home, but utilize that full $400,000 for your own portfolio and growth. And this is the thing that a lot of people miss out on. They miss out on, they just try and live on their cash. They make their $400,000. They go, I'm going to live on my 220. And they're not building that portfolio. So what I love about Michael's book, okay, Michael, I've read your book. I've suggested other people read it, watch it read it or go find it on Amazon. It's awesome. You're talking about, you don't have to go buy 10 rentals in your first year. Go buy one. Just start with one. So tell us what your philosophy is. If I'm just brand new, how do I get started? How do I then make my way towards the cash flow model where I'm not just sitting there living only on my wholesale stuff?
Yeah, I've been lucky enough to know some of the best wholesalers in the Central Valley and around the country. What I often tell them is you have to get to a point where you're basically wholesaling 3, keeping 1, wholesaling 2, keeping 1, right? You have to get to a point where you start to add assets so you can take care of you leveraging depreciation, as you've just outlined for us. Because as you do that over time, it compounds, right? Your example talked about 8 houses, and you got rid of $160,000 in liability to the IRS. That's awesome. But you know what? What if you got rid of just 40 grand of that this year, and then 60 grand and all of that, right? I walk into the year now with somewhere between $350,000 and $400,000 in losses because I have built a portfolio up over time. So I know on January 1st, I can make around $300,000 and the IRS gets dick, right? It's just how it works.
That is the key here. Check that out. That knowing your numbers and understanding that. And so the thing is, people say, well, they don't teach us in high school. They don't teach us in college. Well, you're not ready to hear it then, right? That's why this knowledge is out here. That's why we're doing this is we're going through and learning these things. It's available for everybody. Okay. You imagine if they tried to teach depreciation in high school and even in college, like nobody would understand it, right? You got to go through it. So essentially you're walking into January 1 based on the portfolio you already have. Mm-hmm. And you know that you can go make $300,000 to $400,000 that year tax free. So here's what's interesting. Yeah, go ahead, Brent.
When you buy property, they ask for 2-year tax returns, okay, for conventional financing, right?
Sure.
If you're not showing income because you're writing it all off of depreciation, how do you buy rental properties?
Well, so you have to be very careful. So a financial expert, they will always back out depreciation. Depreciation is a non-cash expense.
This is the thing that people do not understand right here, what he's explaining. I freaking love this answer. Keep going. This gets me pumped.
Yeah, it's smoke, right? If you bring up the example that Pace just walked through, right? And it looks like, right, he leveraged 400 grand, 240 grand in cash, $160,000 in assets are gone by depreciation. A bank is going to back out depreciation because Pace did not write a check for that 160 grand. So on his financial statement, it shows 160, or actually it'll show 400 grand because he had 240.
So that's the thing, is a lot of lenders that will turn people down based on their depreciation are people that doesn't really happen that often. I've heard of it happening once or twice. Those are like loan officers that just got their license 3 days ago. They don't understand the depreciation actually gets backed out. I earned $400,000. I earned that.
No question.
So I didn't write a check for $160,000, or I'm sorry, I didn't write a check for $400,000 to come to zero. They look at my earnings and they look at my ability to pay my bills, right? And so they back out the depreciation. I did not understand that, and I was afraid years ago to take depreciation. And then I had a good LO that was like, yeah, that literally doesn't happen anywhere.
It's a common concern that people think of, but I think that you guys just cleared it. So
yeah, so let's take Pace's example and bring it down to earth for other people. Right? Let's say, for example, your top line number was 400, which he talked about. Let's just say, for example, you spent 240 grand on costs in marketing and just running your business, and then that other 160 grand you did exactly what he talked about. So you're reporting to the IRS zero, because in Pace's earlier example, you're still reporting. Are you still showing 240 grand, right? At least as real income. It's still net zero, but it's still there. This way you can have zero kind of income from your business. It shows zero, but on your financial statement, it'll be backed out, right? It's a non-cash expense.
Got it. Great question here from Phil, if you don't mind, Mike.
I love this question, and I love Phil Gore. He's a great freaking
fantastic
guy.
Yep.
Love Phil Gore. He's a TTPer. And actually, Phil was at the house I signed. One of the deals I helped sign a year ago with you, a sub-2 deal I bought from a dead lady's house. Phil was at that appointment. Love Phil. So here's the answer to that question. Does the depreciation lower your cost basis? And if so, actually, these two have nothing to do with them. No, the depreciation does not lower your cost basis. What the depreciation does in my world is that my money that I put into my rentals is essentially free money when you really think about it, okay? Again, I know Phil Gore. So Phil, let's say that you make this year out there in Texas, let's say you make $200,000 in wholesale. Out of $200,000, let's say you take that home. That's after your expenses. That's after your marketing, after all your stuff. You're going to pay probably on a $200,000 gain, you'll probably pay somewhere about $50,000, right? In taxes, probably somewhere around there.
Pace, will you explain what cost basis means?
Yeah,
Cost
actually,
basis means, go ahead, Michael.
I was going to say, I think he's talking about the cost basis of the asset, not your income.
So, got it.
Yeah. So for example, if you put up a $300,000 number there, or 270,000, just to whatever. Right, 275, I guess would be whatever. Yeah. So what Phil is actually asking for is, yes, when you take your depreciation, and in this case, because it's a house, you'll take $10,000. Again, we're going to ignore land and all that other stuff for this simple example. But again, 27 and a half years divided by 275,000 is $10,000. Right, we're ignoring land and all those other variables.
What is 27 and a half? Sorry, Michael.
That's the depreciation scale for residential properties.
So let me break that down real quick. This is probably the trickiest part of the depreciation, and we're clicking over a couple steps. So if you don't mind, let me jump on that real quick so he can explain that. So here, let's say you have a property that's worth $100,000. What is depreciation? Depreciation is the IRS saying, hey, we think that the end of 27 and a half years on paper, your property is going to deteriorate all the way over here for 27 and a half years. And at the end of it, on paper, it's going to be worth $0. Okay. So what that means is I'm losing a little bit every single year, all the way down the line for 27 and a half years. Where does this 27 and a half years come from? I actually don't know that answer, and I've looked for it a couple of times, but it doesn't matter. That's an IRS number, 27 and a half years. So what it means is that the IRS will give you a credit, a loss every single year on paper. So let's look at $100,000 property. Michael was just breaking that down. Guys, everybody pull out your calculator. We're going to do this together. Type $100,000 into your calculator and divide that by 27.5 years. What does that give you? That means every one of these little credits I get every year. Check this out. One property every single year gives me a tax credit of $3,636 every single year. Now, what I do in my first year is my CPA structures it so that the first 5 years, I take that depreciation all in my first 5 years.
You can
I'm
just
sorry, I
choose
take that in my, say that, Brent, one more time.
You can just choose that. You can just
Yep. You
choose
can
how
do
many
straight
years?
line depreciation, which is just 1 year at a time. You can do 5 years, or you can even do cost segregation, which a lot of times that's a whole nother conversation for another day. That's typically for $1 million properties or multifamily stuff. So we won't go into that today, but that allows you to take 40%, 50% sometimes of the value of the home so I just bought a property in Atlanta. Jamil's actually been to the home. $1.3 million is what the house is worth. I used cost segregation to take a 40% tax credit in 1 year on the same year.
Wow.
So what is 40% of $1.3 million times 0.4 equals? That means I took a $520,000 tax credit on that one property in 1 year because of the tax code. Okay. And that's called cost segregation. We can go through that another day. Okay. But let's go through this simple example of $100,000. So check this out. If I'm Pace, I'm going to take 5 of those years right up front. What is 36 times 5? That is $18,000 I can go make in my wholesale business tax free. Because I went and bought one property. I went and bought one property for $100,000. And that IRS partner that Brent was just talking about is going to allow me to take a tax credit of $18,000. So if I have a wholesale business right here, and that wholesale business makes $18,180, I can offset that from one rental over here by getting actually I should change the color of this so you guys can kind of get the gist of it. I can use that as a credit for the IRS, and it comes over here and it's almost as if I'd never made that money. And guess how much I pay in taxes? A big old whopping 0.
Yep. And then when you fill out your financial statement to get a loan, it shows 18 grand.
There you go. Back to Michael's point from earlier. Michael makes a good point. A good financial, loan officer, not even good. This is just commonplace. It's the ones that are idiots that don't do it that way. So when people are like, how are you paying no taxes? You're cheating the IRS. No, the IRS, as Brent said earlier, wants you as their partner to go and provide affordable housing and clean up the neighborhoods. They're not good with housing. And so they're incentivizing you, please make our neighborhoods nice. Please go and invest in our government. And in doing so, we will allow you and your family to build massive wealth, because obviously if you do this well one time, you'll do it over and over and over and over and over and over and over. And next thing you know, so this is why, he talks about one rental at a time.
Mm-hmm.
It's what I call the snowball. You start with a little snowball and it gets bigger and bigger and bigger. Next thing you know, it's so big. The momentum is so massive that it can't be stopped. And that's where you look at these guys that are billionaires and they're, Jamil and I were at the airport the other day and we saw these 2 kids come off of a private plane and nobody else. 2 kids come off of a private plane. Those guys have cash flow. Those guys they're flying their kids around on private jets, not even worrying about money. They have passive income. They have built massive, massive wealth. And so the beginning of that is one rental at a time. Mm-hmm. The fastest way to make more money, this is the greatest thing, Tom Breslow. This is so great. I love this question because I was confused by this for a very, very long time. I'm sorry this is turning into the Pace show, guys. Michael, do you tell me your strategy? I just learned a couple of strategies this last week and I would love to share with everybody. Some you may not know about, maybe you do. But what would you do to avoid tax depreciation recapture? Now, here's the thing. What is tax depreciation recapture, guys? Everybody keeps asking about it. Is this. Let me share my screen and then we'll let Michael answer this question. So you see this $18,000 right here? essentially what recapture means is they say, well, you took a credit against your income for $18,000. Okay. That means that when you sell the property and you actually don't reinvest that money into anything, we want that credit back. Okay. So that's what recapture is they're saying, well, we want that $18,000 back because you're no longer.
Sort of. You got to
I'm
be
making
careful.
it simple. I'm just trying to make it as simple as possible.
Well, let's do it this way because I'm an accountant, so I get a little frisky.
Love
Right.
it.
So basically what you're saying in your example, you can bring it back up, right? You had $100,000 house when you bought it. You then wrote off $18,000 in depreciation.
Mm-hmm.
So on the financial statement, that asset now, again, with rounding, shows an asset value of $82,000.
Right.
Right. Because you wrote, yeah. So the asset is now 82,000. You do that again, right? That's basically taking the purchase price, and over 27 and a half years, it goes all the way to zero. Right. So it shows up at zero.
So essentially, guys, you're taking a credit, and there is something called recapture, which means the IRS says, hey, when you sell that property, we have to settle on this. Okay. I'm going to keep it really simple without us going down another tangent, but we've got to settle on the 18,000. And what people go is they say, well, I don't want to take depreciation on my rental because that means I have to pay it back in the form of recapture. Now, that's where a 1031 exchange is highly beneficial. Michael, is that the main way that you would suggest?
Well, there's a couple of ways that I know of. And one of them I love and one of them I hate, but they both work.
Okay.
So first and foremost, there's this thing in the IRS tax code called a 1031 exchange. And I've executed a dozen of these. It basically allows you to sell one asset, move that equity into something bigger, and the IRS gets nothing. So you could have an asset in your example of 100 grand. Let's say you held it for 27 years. It's now worth zero. Instead of selling it to a cash buyer, which you're then going to have to pay 40% taxes on, you could sell it via 1031 exchange and then go buy another house and start it all over again.
Right.
You pay nothing to the IRS. All of that recapture goes to the new asset.
Right. And so we call that step-up basis.
Exactly. It's a stepped-up basis into a new asset. I've done that a dozen times and will continue to do that. I plan. The only time I will sell an asset for cash is if it's just not performing. And again, remember that 300 grand I walk into the year with? If I can use it so I end up not paying the IRS. I get choices with the way my tax structure is set. But there is one other way, at least that I know of. You may know of others, Pace, given your mastermind. The other one is you could die. I don't really like that strategy, right? You could die because then what happens is you have a stepped up basis to your children or your heirs or whatever that is. You don't even have to sell it. The write-off on your taxes are gone. It is then evaluated at its current price, right? You bought it at 127 and a half years ago. It's now worth $1 million. Under the current rules, it's stepped up. It's valued at $1 million. And the beauty is your kids get to depreciate it for 27 and a half years at $1 million. It's beautiful.
Michael, is there a point in the ownership or the age of a property that you decide that you want to sell it in 1031? Because I think that, something that at least goes through my head, I know it's gone, I've talked to some other people is, yeah, that's great, but these properties get old. I got to fix these properties up. Yeah, I'm saving 18,000 on my taxes, but I just paid 15,000 to put a new roof on, a new kitchen, a new bathroom, all of these things, all of these costs. Is there a point where you buy properties that are in a certain condition and you get the juice out of those and then you move on and you sell it and let somebody else deal with it?
So there is, but it's not for what you're highlighting, right? Again, something you'll see in my book if you get a chance to read it, Brent, is it is very hard to find a deal. So my intention at point of purchase is to hold forever.
Got it.
With one caveat. I've been doing this 20 years and there's been 2 or 3 cycles where newbie investors want to overpay for what I own. And if you ever want to overpay for something I own, I will gladly sell it to you.
All day.
all day. Right? So, it happens all the time, right? 2007 or 8, everybody was buying houses. So I sold, real example. I bought a house for 107 in 2000. And again, you could look it up on Zillow, 1818 Norris Drive East. Can you look it up, Pace? Pull it up on Zillow in the
Yeah, I can pull it up. Yeah. Let me
look it up
real quick.
What's
the address? Hold on. Give me a second.
Oh, sorry.
Go ahead.
1818 Norris, that's Norris Drive East.
93703.
You got it.
Let's pull it up.
So go down to the sales or whatever the records are, like past sales or whatever. So that's the house. That was the first house I bought back in December of 2002. Look at you. You're fancy. I have no idea how you're doing this.
I'll tell you. I'll tell you after the show.
All right. So somewhere it'll show you the sales history in Zillow.
Okay, here we go.
There it is, price and tax history. So if you can focus in on that, you'll see in the history that I bought it in December of 02 for 107.
Mm-hmm.
See it there? I sold it not 3 years later for 264.
Mm-hmm.
Now, why did I do that? Well, because people were overpaying. But again, remember, I'm a cash flow investor. I rented that thing in 2002 for $1,100. It was still renting for $1,100 in 2005. That is a classic alligator, negative cash flow. It doesn't matter what you call it. Okay. But that's no, you got to go back. We're not done yet. I'm sorry.
No, don't be sorry.
Scroll down and show, no, the other way. Yeah. The other way. Sorry. So that person who bought it for me lost it 4 years later. And in an REO, it sold for 75 grand. Right. This is the crash, the Great Recession, up close and personal. And oh, by the way, it just sold in 17 for 153. And today it's worth 200. But remember, in 05, I sold it for 264. It is not, it's 30% less than what I sold it for 15 years ago. That's a classic example. If you want to overpay for something I own, I will sell it. But to this conversation, I 1031 this into an apartment building that I still own today.
There it is. Yep. So that's the time that you use the 1031. You're buying everything to hold it forever. And unless somebody wants to come with a ton of money, and you are the classic investor that we have all called and said, hey, listen, at the right price, I'll sell. and it's all, I tell everybody, ignore that guy. Don't call him back. He's not selling at a discount. I'm telling you right now. You know what I mean?
Yeah, well, let's talk about that. That was something I was hoping we were going to get to on this conversation, because I am the person all of you call. Right?
Yep.
Maybe not. Actually, Jamil would call me, but for a different reason, because I got money. So here's what I see from wholesalers, and this may not be TPT, it may not be PACE, but in general, right? The community that we are all in and we're trying to help today. Most of them, when I talk to them, or I coach them, or I try to help them, talk about, hey, I'm trying to look for sellers. I'm calling the seller. I'm spending money on mailers and texting and all of that, all for sellers. I would suggest you would do yourself a favor if you treated that and you took it from sellers and said, I'm marketing to owners. Because yes, you want sellers because that's where you get your checks from. But if you treated that first contact or that first communication different, you actually might learn stuff. You actually may find your number one cash buyer. I tell you what, I get 5 to 10 contacts a day, and they're all saying, hey, can I buy property XYZ from you? No, fucker, I don't know who you are. I'm not having this conversation again. Right? Sorry, I get passionate about this. But if you called me and said, hey, I'm an investor in Fresno. I'm looking at properties all the time. I see you own in this area. What are things that you look for? Oh, we might have that conversation. And oh, by the way, I guarantee you, if I'm having a problem with a tenant, it will come up in the conversation. And maybe at the end of that, you can, kind of pivot and say, you know what, would you ever consider selling? I think too many people have been trained to say, hey, can I buy X? Can I buy X? Can I buy X? Hey, I'm new. I'm this, I'm that. And then the second thing I wanted to talk about, just because I'm looking to help, what I have heard from wholesalers is it takes 8 contacts to close a deal. Right? My career was selling software over the phone for millions of dollars. You never did that on your first phone call. So what I suggest you change is you try to make your first phone call about getting a yes answer for a second phone call. And then you take your second phone call looking to get a yes answer for a third phone call. Build the relationship, add value, help people. Because when you do this correctly, not only will I tell you about my world, but if you are truly adding value to me and we're building that friendship and relationship, I will tell you about my friends that own stuff or my friends that could be buyers. Right? We are too fast to close. And believe me, I was in tech sales. People make a gob of money and people always want to go for the close. But in my world, it took 15 to 20 contacts, phone calls, meetings, to get $1 million deal. It's not the first phone call or the first contact is extremely valuable. And I think it is underappreciated. It is being done. It is being taught incorrectly by many people in the industry today. And I think this community could do it better. And if you just pivot your conversation a little bit, because you've got about 5 seconds with me before I hang up on you, right?
5 seconds to get 30 more. That's the rule.
Exactly. And I think if you treated it as you're calling an owner versus seller, that little pivot in your mindset
always
is huge. So that's 2 things that I knew I wanted to talk about today. So I'm glad I got them off my chest.
Huge mistakes, Michael, that they go, hey, I'm an investor. Do you want to sell your house? That's terrible. The second one is they don't use any of their own efforts. They hire a Filipino for $3 to $5 an hour that has no idea what you're talking about. And that it's just low hanging fruit. It's just low hanging fruit. It doesn't work. That's over. It's over.
Yes, sir.
Yep.
Good.
Totally agree with you.
Awesome.
Yep.
I'm going to give everybody the link to one rental at a time. It keeps coming up. I'm going to pull this up for you guys in the Amazon, in Amazon.
You're very nice. Thank you.
Guys, please.
Do you see these, Michael? Holy cow.
We've had basically 400 people watching live this entire show.
Oh, wow.
This has been a great show. Great comments. Everybody, please show this guy some love. Michael, how can I find you on Instagram? We've got basically 30 minutes more to go. I think we should start answering some questions out of the side. How can people get a hold of you on Instagram? Is it Instagram?
The beauty of everything I do is one rental at a time. I certainly have an Instagram channel, but my main content is 4 original pieces of content on YouTube. My channel, of course, is called One Rental at a Time. 4 original pieces. You get a daily financial news at 7:30 a.m. every day. It's live every day. Then I interview 7 or 8 multimillionaires every week, Monday through Friday, and those turn into 3 videos a day. So I am truly trying to help people get nothing for all of this. The beauty of me is that I'm a morning person, so my work on YouTube is done by 9 a.m. And then I go about my day. I'm really trying to help just like the 3 of you. That's why I was so lucky to get invited to this show.
Hey, Pace, is there a way that Jamil can say something? Is he muted?
He muted himself.
Oh, okay. I thought you had muted him.
No, Jamil, you got to unmute yourself, bro. I tried to unmute you.
Well, I mean, here's the thing, right? You guys know I'm not a big holder. I sold all of my holdings 8 months ago to a hedge fund. Same thing Michael's talking about. I got offered, 20% over market value so they could gain control of a building. And it was a stupid number, so I sold it. I sold my holdings, and I would do that over and over and over again. On the flip side of that, working with my buy and hold buyers, it's really interesting to me to hear Mike's thought process when he's being approached by wholesalers. And he says he's getting called and texted and approached day after day after day. And all he's saying is, look, treat me like I'm a human. Treat me like I'm an owner. Talk to me like we are on the same page. This can't be just this repetitive, hey, do you want to sell? Hey, do you want to sell? Hey, do you want to sell? You want to have a conversation with a portfolio owner, learn how to approach a portfolio owner. So what I'd like to ask you, Michael, is beyond just that, hey, be a little bit more personal or personable to me. What could some other approaches that you could think of wholesalers could take when they're wanting to talk to you? What about calling you with a deal? What about not calling you to see if you want to sell? What about calling to see if you want to buy?
Exactly. This is the conversation I was hoping we were going to have for at least a part of this 90 minutes. Again, what I want you to do is I want you to realize you all have bought lists. You have bought lists of owners. And if you treat that list with the kid gloves or the respect it is, there is so much gold in there that you are all missing. So what I would do is, again, I would just scroll down the list like you're doing today and say, hey, hey, Michael, I see that you own 123 Park Avenue, blah, blah, blah. I'm looking to invest in that area. I was wondering if you could answer 2 questions for me. You've asked permission and then you shut up. If I got that question, and even if I don't know who you are, I'm like, yeah, I can answer 2 questions. First question, and again, I'm just thinking off the top of my head so you guys can script this, get better at it. But the first question would be, how have you liked the area? And then shut up. Because I'm going to do one of two things. I'm going to say, I love it. It's been rented forever, no turnover. Or I'm going to tell you it's terrible. I have constant problems. The police are always there. You are going to hear pain if you shut up. So that's question one. Question two, back to your point, Jamil, is would you ever think about buying more in that area and then shut up? Because A, the answer could be, yeah, I'm looking to add to my portfolio. Great. You're a buyer. What are you looking for? You've added value. Or two, I wouldn't buy another thing in this area if you put a gun to my head. Pain.
Oh my gosh. I think it. I don't know if people caught it, so I want to highlight what you said there in a real short form. Mike said, why not approach the question with, hey, Mike, I'm an investor as well. I see you have a rental in this area. I have a question for you. I'm looking to buy there. Tell me about the area.
Yeah, and again, I don't even know if I'd go that far. Hey, I'm looking in the area. Can I ask you two questions? Because the first thing you need to do is you need to have me time block in my head. 2 questions, 5 minutes. Okay, go. Right. Then you could talk about, hey, I'm looking. I don't think it needs to be long. It needs to be short and brief. Ask permission and then shut up.
Beautiful, beautiful, beautiful. I mean, every one of our viewers that is potentially wanting to talk to a portfolio owner about selling needs to take heed to what Michael's saying. In all honesty, this is great stuff.
I accidentally muted myself, but I love these comments on the sides, guys. I thank you so much.
You had mentioned in Michael's office that he does wholesale and rentals and what else?
He has an Airbnb shop as well.
Got it.
Airbnb, general contractor, licensed realtors. I've put the best and brightest in Fresno in that office on purpose because I'm trying to be a one-stop shop for everyone. And again, let's remember, I own the office. It's mine. I get to call the shots. These are all independent entities. I do not have employees. I don't want employees. I have a very good life. I want no headaches. But if I can provide a incubation for the best and brightest, if I can provide a one-stop shop for anybody that's looking to make a transaction in Fresno, I've got it. Licensed agents, licensed contractor, wholesalers, flippers, buy and hold, Airbnb. There's the loan broker going in. It's just a wonderful place. And I'm doing that on purpose because I want to help people. That office cost me almost $300,000. But I did it because I know it can help people for a long time. And after I'm dead and gone, it will be put into some kind of trust so it keeps helping people going forward.
And have you built up that reputation in the market that people just refer you deals? Is that where you're getting most of your opportunities?
I would say it's all my opportunities in 2020. I've been known, if you read my book, I bought 99% of my stuff out of the MLS. Go figure. Hundreds of units out of the MLS. MLS has been terrible the last year because of all these damn owner occupants and no supply. I got all my deals in 2020 because of reputation. I probably averaged 40% from my reputation because, again, what do I do? And again, I tell all new investors this. Yes, you know what you're looking for, and you may know people in your market. Here's the deal, Brent. I've never lived in Fresno. I have never spent the night in Fresno. But I can guarantee you there are hundreds, if not thousands of people that know me, but more importantly, know me and know what I'm looking for. That last part is value, right? I tell everybody I talk to, brand new agent, closing clerk, insurance agents, other investors. Yeah, great. Hey, I like the Tower District. I like Old Fig Garden. I'm looking for something under $300,000, 3 or 4 bedrooms. I mean, we just have a casual conversation. Everybody knows what I'm looking for.
How long did it take to build up the reputation? Because and the reason I ask these, Michael, is we talk about starting out and you're out there and you're grinding and you're being proactive and you're door knocking, you're making calls, you're sending letters, you're doing bandits, you're doing something to find opportunity to the point where you build up enough of a reputation in your area where people start bringing you deals. Very a la, Jamil and Keegley. People are just bringing them stuff to help them sell it, to help them comp it, to do all these things. How long did it take you to build that in your business to where you become the guy in a town you don't live in?
Yeah. So it's very much the snowball analogy that Pace offered earlier. I wish I had a better answer for you. It starts slowly. Yeah. I think the first referral that I got from my business was after 5 years, but realize I did none of those things. I was a guy that was on an airplane looking at the web to buy deals. But I can tell you this much: 2010, so I've been 8 years into my business. I closed more transactions in 2010. I added more net worth to my life than I've ever done before because of my reputation. I closed deals faster than anyone. My word was my bond. I would even close a bad deal if I said yes. 2010 does not happen without my reputation.
And the market.
Oh, of course. Fair enough.
That was a good time to buy. Smart move.
So what are your thoughts on the upcoming 2021, 2022 market? What do you feel like we're going to see, especially as a buy and hold investor? I know you hold forever. So for you, at the end of the day, it's like, well, let it go up and go down. It doesn't bother me. I'm going to continue to cash flow. But in terms of acquiring more assets, obviously you want to get the best deal possible. Do you feel like there's some impending horrible crash coming up in the next 18 months? Or do you feel like we've got some decent wave we're going to ride?
Oh, there is no crash coming to single family homes. Anybody who talks about a 30 or 40% crash does not understand math, doesn't understand what's going on. There will be no crash in 2021 or 2022. It's mathematically impossible. There will be some cities like San Francisco, like LA, like New York, like Chicago, like Seattle, that will see some price deterioration, but 90% of the country is going to have appreciation. I own lots of stuff, apartments through houses. Apartments are rough today, rough. You want to talk about tenants going on rent strike. You want to talk about tenants doing all these things. It's happening in apartments. Single family is on fire. Single family is on fire for appreciation, for demand, for rents. It is the best thing to own today. And oh, by the way, when you have a debt structure on single family homes that is 30-year fixed, now is the best time in the world to buy single family homes, especially before what will likely be an inflation spike in the coming years to come. Go get as many 30-year debt sub 3% that you can, and you will be happy, 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 happy. I think nationally speaking, and again, it's hard to talk nationally, we were up nationally 8% last year. I think we could go at least 8% next year, or this year, sorry, 2020, 2021. We will not have a crash. It's impossible. The only thing that could cause a crash, there's only one, is if Janet Yellen takes the federal funds rate, which essentially is 0 today, and jacks it up to 5%. If she takes it from 0 to 5%, which is 20 moves at a quarter at a time, that will take 30-year notes to about 7.5%. That would crush housing. But Janet Yellen has never found a spending spree she doesn't like. She likes to spend our money like a drunken sailor, so she's not going to do that. But outside of that one thing, is the only thing that could crush housing nationally.
So what would that actually cause? That would, for anybody that's on here, they don't understand that. It basically just means buyers are not buying homes because either A, they can't afford the payment, or B, they're waiting for a better deal, which is, Michael, you're older than us, probably by a good 5 years or so. When my parents were buying their first home, I remember the interest rate was 12 or 14%.
Mm-hmm.
But also the price of a home back then was $30,000, right? So you've got homes now $300,000. You have a 7.5% rate on those. Oh my gosh! Like, think about people are just going to go rent. Nobody's going to buy a house.
Yeah, that's
people
the
are
big
buying. Fix and flippers, home builders, all that kind of stuff. It's gone.
Done. Zero. Zappo. Nothing. The only thing that gets done is subject to deals because they have 30-year fixed rate money at 3%. That's the only stuff that transacts. And anybody who owns it free and clear, that stuff will transact, but at a greatly reduced price. That's the only stuff. But here's the deal, folks. People buy on payments. I've been doing this 20 years. I have an MBA, an accounting degree, all this nonsense. People buy with payments. So what people love to do, like these YouTube entertainers out there, these people that are like 27 and have never seen a crash, they go, hey, look, the price is the same today as it was in 07. That is idiotic and stupid. You know what the interest rate was? Because I was buying back then. I was getting a 7%. Yeah, 6 to 7%. Yeah. So let's just assume a 300K house in 07 is a 300K house in 2020. Do the math on a payment. The payment's about 30% less today. And, oh, by the way, we've had inflation in income. It is not a bubble. We are not in a real, not saying we couldn't get to one with Janet Yellen printing money like crazy, but we are not in one today.
Right. I like this question that Johnny Sanchez poses because this is kind of an individual question. And it also, for me, it comes down to age. So Johnny Sanchez says, if I have $200,000 equity in my home, should I cash out, refi, or line of credit to invest? Now, me personally, I love debt. I'm leveraging debt constantly. I just bought a deal from a TTP student today. It's a $500,000 home. I put $7,000 down. It's going to
That's awesome.
Literally, it's a 2% note that I'm taking over. 2%, 30 years. And I'm turning it into an Airbnb. It's like on a lake and all this stuff up in North Peoria area. And I'll probably cash flow a net $4,000 a month. In 3 months, I'll have my full investment back. And for the rest of my life, that thing will just pound money into my pocket, which is amazing. So for me, I look at cash in a property, like especially if I had that much equity in my personal property, I would look at that as dead money. Now, Brent and I are going to disagree on this because Brent has a philosophy of, I want to pay things off with cash. I know a lot of people that have that philosophy. So it comes down to a personal decision. Okay. And there's a lot of really good arguments both ways. But for me, at the age I'm at right now, I would prefer to leverage not as much as I can unsafely, but I want to safely leverage what I can to buy as many assets as I possibly can. With sub 2 specifically, that $200,000 could go buy me at least 8 properties worth of down payment, or not down payments, but like cash to the seller, closing costs, cleanup, a couple months of payments while I'm renting it out. I now have 8 properties cash flowing and getting depreciation, appreciation, mortgage pay down, and all these other things. Those 8 properties they pay for my entire house payment. I never have to worry about another house payment as long as I live. In fact, probably probably 5 of those properties pay for my mortgage. Now I have a free house. What is the $200,000 doing for you sitting in your property? Now, that's a personal question, but I know, Johnny, you're a younger guy. I would go, man, how do I buy as many 30-year notes as I possibly can, whether it's sub 2, seller finance, or even the burst strategy if you decide to go that route. How do you take that $200,000 and get 8 to 10 cash flowing properties that you'll have for the rest of your life? What are your guys' thoughts?
Well, there's a couple of things there, right? So I think based on the question, he is in your camp. What he's asking you though is, do I do a cash out refi or a line of credit? Because he wants the money, right? At least that's how I read the question. He's already sold on taking the capital. So I don't think that's
all right. Cool.
I don't think.
Yeah, I would say real quick before Michael answers his question, or the question is, I would say a cash out refi is probably going to give you a better rate, especially right now, than a line of credit. So I would go a cash out refi route, and I would pull out as much as I possibly can at the rates that are at today, which probably could get like a 2.8% interest rate.
Yeah, I mean, I think that's the only option in today's market is to do a cash out refi. Realize you have $200K in equity. I mean, it's hard to assume what the house is worth. You're not going to get all $200K. The bank is going to want to keep some equity there for their cushion. You probably could safely assuming it's $200K equity, I don't know, 140-ish, maybe. I'm just guessing. They're not going to give you all of it, is my point.
No. That's why the burst strategy sucks. But anyway, no, I'm kidding. The burst strategy really does work. Obviously, Michael, I'm sure you've used the burst strategy a lot on your portfolio, right? It does work. Yeah. It just is a little bit slower. It takes a little bit more time and energy, and you do have to have a pretty good situation. Dude, the comments in here are strong. This has been a really, really good show, Michael. Guys, if you haven't gone to Amazon to buy his book.
Thank you, Michael. All that. Come on.
Thank you.
When you get TTP to take notes, this guy knows his crap. So guys, go to Amazon. Just go to Google. Type in one rental at a time, Amazon, one rental at a time, Michael Zuber. You'll find the book. Very, very simple. Okay. Now, a couple of really good questions on here. I like this. So Mark Ingrid Hernandez, cash out refi. It's what I'm doing, but not going past 75% LTV because I don't want to be over leveraged. Interesting. So people that are afraid of being over leveraged, why is over leverage a scary thing, Michael?
Well, first, back to your point about your age, right? I don't know Mark. I don't know Mark from Mary or John or whatever. But if some people have experienced the '08 crash, it was absolutely an over leverage problem, right? So there are people that may have experienced that themselves, or worse yet, you're younger, but your parents went through it, right? So one of the things I won't do in any of my assets is go over 75%. Now realize a bank on an investment loan won't even go above 80%. So it's not like I'm leaving a lot of money on the table, but you got to remember, I'm a cash flow investor. So if I like an asset, but it won't cash flow at 75% down, I have a choice. Get a lower price, put more down, or don't do the deal, right? That's it. I do not like alligators. Paige, you read my book. The only picture in the book is an alligator eating a bag full of money because I did a cash. Remember that property you looked up earlier, 1818 Norris Drive? What we didn't talk about is I did a cash out refi in about 18 months. And this is what happened. I went to a bank. My bank said, hey, we'll give you all of the money because it was crazy lending. Mm-hmm. And they said, how much do you want? I said, I don't know. I'll take it all. So this is what happened. I got my first mortgage payment after I did the refi, and my payment was about $1,200. But remember what the rent was? It was $1,195. So even if the property did nothing wrong, I was losing money. I will never do that again. I want every asset to stand on its own. I don't want to go, hey, I like that purple house so much, I'm willing to have that be negative because the yellow house will pay for it. No, that damn purple house stands on its own, or I don't do the deal. Every asset is unique.
I think that's so important. I mean, 100% every property has to stand on its own. And the second thing that I thought was just brilliant, and this is just something coming from your experience, Michael, is in a random pandemic, multifamily is getting chewed up, right? Chewed up. So you think to yourself, okay, well, maybe there won't be another pandemic for another 100 years or whatever. So I'll be fine if I buy multifamily, but you never know. You have to think about that. That's got to be in the back of your head all the time. What happens if something like this happens again? And I think it's going to be really interesting. And I want to see what happens with the market. See if if multifamily takes a dip, or if people just keep going forward and just stay in love with it. I don't know. It might be a potential opportunity in the future, but who knows? But it's interesting. It's interesting. Yeah, that's crazy.
So Curtis Williams says, thanks for all the valuable information. I'm working on my first wholesale deal. Let's remind ourselves why we're here, guys. This conversation we're having is that wholesale provides the opportunity to have cash. Okay, so where do my opportunities come from? My opportunities come from one place, my wholesale operation, right? And I shouldn't say wholesale operation. I'm targeting motivated sellers. That's what I'm doing. I'm targeting motivated sellers. And once you understand how to wholesale some, make some chunks of cash, fix and flip a few here and there, and then start buying long-term assets, that's the business model. But it doesn't start by you just waking up one day and going, I'm going to start buying rental properties. Unfortunately, you've got to learn how to either raise private capital or you got to go make some money. And wholesale is the fastest way to get out and make money without experience. And that's the whole purpose of Wholesale Hotline. So hopefully you guys got a tremendous amount of value tonight. I haven't seen the comments this amazing and since Rochelle Jarvis was on the show.
And do you mind real quick if Jamil and I just beat up that last with Johnny when he talked about pulling out $200,000 in equity? Jamil, what's your thoughts there? Do you think it's smart for him to pull out equity right now, or do you think that he should keep it in there and keep working on his business and stay focused?
I can only speak from my perspective and what I do, right? Yep. And so I don't have a mortgage. And I don't have a mortgage on my house because I'm just like Michael had talked about. I'm fearful. I went through 2008. My whole family got diminished. All of us were homeless. I've seen it happen. I've seen how predatory banks can be. I've seen the rules change without you even knowing what happened. And so because I've seen how strong and how powerful lending institutions can be, because I've seen how lending institutions get the government behind them to do their bidding, because I've seen those same government agencies send their armed people to my home to get me out of my home when I wasn't supposed to be there anymore. I ain't fucking with it. I don't do that because it's not for me. I don't do mortgages because they're not for me. I'm going to always own my stuff in cash. I believe in cash. I believe that what we learned from Michael today, from my perspective, was how do you talk to a buy and hold investor? What does a buy and hold investor care about? What are the things they want to know? How do you hold your own in a conversation with somebody that is this astute with the cash flow game? How do you understand depreciation? How do you use the conversation of depreciation to talk about selling? How do you talk about 1031s and how that could trigger a sale? These are the things that I think really apply to wholesale, and especially the people that are listening today. I think this absolutely applies to everything that they're doing with respect to how to approach a buy and hold investor. And I think that what Pace and Michael got into today was mind blowing, because I learned a ton. Although I had learned a lot of what Pace was talking about earlier, just listening, I'm still lost. I'm still lost in a lot of those conversations. So hearing Michael and Pace talk it through, and Pace being able to give us those diagrams of what that would actually look like drawn out, it made a lot of sense to me. And I was a student tonight. Thought it was great.
You said it perfect.
This is fun stuff.
I echo the same sentiments. Yeah. I foreclosed on 5 properties in 2009 and 10, and Michael might have bought them. No, but no. And I get it. I think that 100%, I will always encourage people to own at least one property completely free and clear.
Yeah. Let me give my thought. I agree. So I retired from the workforce, left a 6-figure job in 2018, February 1st. So almost 3 years ago. One of the first things I did before I left is I repositioned my portfolio. I was Pace before I left. Everything had debt. But I walked up to about 6 months knowing I was going to be out. I'm like, I ain't leaving this without a pile of stuff free and clear. So I went in and levered up my 4plexes, my triplexes, and I paid off a lot of houses. Why? Because I saw 08 up close and personal. I now have a set of houses that I call my O blank pile, that if everything else goes to crap, I know I have this pile free and clear. I can sleep at night, right? You got to know where you are in your growth game. If you're in year 1, debt. You're in year 10, year 15. You know what? Maybe pay some of that stuff off. And then lastly, to Jamil's point, I strongly believe in paying off your house. I hate it when I hear people go, I want to max leverage my own home. That's where your wife lives, your husband lives. That's where your kids are. The last thing you want to do is have armed guards come in and throw your shit out on the street. That's not a good feeling. Straight up. I'm not a person, when people ask me, should I add debt on my primary? It's like, are you single? If you're single, I don't care. Go nuts. It's yours. But you have a family, kids in school, forget it. No chance in hell I'm going to give.
Such a great answer. It goes back to what I was saying at the beginning. It was like, it's such a personal question. It depends on who you are, what age you're in, who you have that relies on you. All of that stuff comes into that question.
I'm going to give this
the bell, bro.
That was perfect. That's it.
And for the record, guys, I do own multiple properties free and clear that I've sold off. I've sold those homes on seller finance, so I don't have to deal with them.
Yeah.
So, I just my personal home, I bought it subject to, right? So I bought this house subject to a year and a half ago, and my mortgage rate is like 2.8%. It, for me personally, it doesn't make sense for me to pay this off like in chunks. I'll let it pay off over time. Right.
Sure. Absolutely.
And also, this is not my forever home. My plan is like in about 15 years, when I get TTP money, I'm going to move into TTP's neighborhood. Okay. I might even be able to get close to Jamil's neighborhood. So I do agree with all of this stuff. And, you know, we were in Orlando the last couple of days, and we had the opportunity of talking to a bunch of married couples, and it's typically the wife is the one that's going to be more foundational mindset of like stability. And it's the man that's going to be like, I want to go out and conquer the world. And thank goodness we have those women to keep us like reeled in from time to time. So Johnny, I know you're a younger guy, so you can be a little bit more aggressive. I mean, think about it. There's a lot of people that were in their 40s, 50s that lost everything in the crash and still were able to make it up. But if you're 77, if you're 62, these conversations shouldn't even be for you, right? You should have already been doing this a while, but not really. I mean, you still can make a good fortune. I know a couple of guys. I had a guy, it was a big framer, worked had a big, massive construction company doing 20,000 square foot homes in 2006, 7, when they were building all these massive mansions. He lost his entire business. He was 62 years old. He was like a month away from retiring. He had to go work for Home Depot. He had to go do all that kind of stuff. Now he's, in his 70s. He's worth $10 million again. So you still have time if you're going to go put in the work, but you really don't want to start all over at 62.
No.
So I agree. There's transition, there's phases, and that's going back to mentors and coaches and masterminds and being around people that are like-minded. And a lot of them need to be on the same path. I mean, Jamil and I are sitting there in this mastermind in Miami a couple of days ago, and I'm filling up a page of notes thinking I knew something about tax depreciation recapture. Crazy. And I got schooled for 9 hours the other day by an amazing tax accountant that I had never heard any of this stuff. And it makes 100% sense. So you got to keep learning. And that's the fun part about what we get to do. We get to freaking learn how to make money all day long. How cool is our job?
Amazing.
Pretty awesome.
It's the freaking best. I'm going to echo this one more time and I'll shut up. One, Michael Zuber's a badass. Appreciate you a lot. Always enjoy hanging out with you. Your stuff is amazing. Guys, get the book one rental at a time. Subscribe to his YouTube channel. He's always spitting fire. Another thing I want to point out is that we've had really good comments in the comment section all night long. You guys throwing love to our guests. We really appreciate that. Michael doesn't get paid to be here. His book is incredibly inexpensive. He's not making money on the book. He's just trying to get the help out there. I've had multiple conversations about his book with them. It's not a profit center for him. It's a place to help people. So give the man some love, buy the book, and we'll have him back. This was a really great conversation. Maybe we will deep dive next time.
Love it. Thank you, Michael. That was incredible. Guys, this is who you're going to be speaking with. These are the cash buyers that you want to reach out and have a quality conversation with and build that relationship, and look at him as an example of building up a reputation in his marketplace as the guy to go to that makes deals easy and smooth. And that's where we want to be. At some point, we all want to be Jamil. We all want to be Pace. We all want to be Michael. And that's it. That's our show. Fantastic. Oh, 500 people, 400 people tonight. Incredible. So, Jamil, you crushed it. I mean, you were kind of a chatterbox, but you crushed it, Jamil. So
sometimes, you do what Michael said and shut the fuck up.
Yeah, that's it. That's it.
Michael, what are your final words, my brother?
I think you said it best, Pace. We get paid to go learn how to make money. That's exactly what this is all about. So have fun, ask for help, keep going. Don't. There will be bad days, but pick yourself up, keep going. The good days far outweigh the bad days.
Amazing. Thank you guys. Have a great evening. We will see you next week on Wholesale Hotline.